Okay, hello everyone. Here is the second episode of the Nomad Investing. Today with me is Dylan. I am a long subscriber to Dylan's Substack. Dylan has a really good due diligence on a lot of companies that probably most people never heard of, and that have a little downside and a huge upside. So, Dylan, can you a bit introduce yourself, talk about your background, what you do for a living, how did you start the investing?
Yeah, sure. Well, first of all, thanks for having me on. Yeah, so right now, um, as you noted, I have a subscription service that I run. It's free. Kind of write my investment ideas, and then on top of that, I'm managing a small fund, which started earlier this year in January, so it's 6 months in. But in terms of background, I'm Canadian, and I took actually an unconventional path, but I went to law school, and so was a practicing litigator for the beginning of my career. Maybe 5 years of doing that. And while that was happening, even before that, I'd always kind of been interested in investing and was like, kind of like running my own accounts. And then kind of closer to the end of my legal career, I was like, which is not unusual, but like pretty like disillusioned with that career. And as I was like kind of thinking about exiting, I started the Substack, and that's sort of like snowballed, right? Like I wrote a couple of ideas, went on Twitter, got some traction, and then kind of just took a leap of faith, like quit my law job, and had like really no idea what was going to happen. Um, I wasn't, honestly, like I had no intention of even starting a fund, but basically like one thing led to another, right? So I was just kind of doing the writing stuff. I had enough saved up to sort of not have to make a decision right away. So I was just investing my own book and writing, and then I actually did a few podcasts like this. I had some good pitches that got people excited, and eventually like some people reached out and asked if I could run money for them. And then that eventually got to a point where I could, at least try to make a career out of it. So that's where we are now, right? Like 6 months in, we'll see what happens. Very sink or swim business, obviously, but so far so good. That's kind of where we're at now, right? So the kind of style of the investing strategy is like very pretty concentrated, probably on about 15 positions, give or take, right now. It's almost always um, sub $1 billion market cap. It's like small, and actually like I say sub a billion, but most of it is probably like less than 500 million. And a handful of positions are probably even under 100 million. So like really small, right? And that's kind of the benefit of having a uh small AUM is that like I can buy things that are off limits for a lot of other people. And tend to be more mispriced, and it's like low turnover, kind of like get to know the companies really well. You can kind of see the strategy like in my Substack, right? And like not going to see like a lot of ideas, right? Like I probably only like pitching like a deep dive, once every couple months, just because like I don't have a lot of ideas. It's not a lot of turnover. It's mostly kind of just like following the things I know really well. And that's kind of it. I mean, it's not like complicated trading strategies or anything, right? It's all just fundamental research kind of driven.
Okay. And in terms of your fund, I'm just curious because I've never seen people who are running the fund. Like, how does it work? People give you their credentials for the broker, or they just send you money and you invest on your behalf, and then when they
Yeah,
wanna like get rid of the funds, you sell some position and return money back to them.
exactly. So it's the latter, right? So the first thing you're kind of getting at is more of like a separately managed account structure where you would kind of have various accounts for everyone. But the fund is actually just like it's pooled money, right? So somebody subscribes, and then they transfer the money and it goes into the fund, and then it's all commingled. And then if somebody wants to redeem, then you give a notice to redeem, and then something has to get sold, and they get whatever their interest is worth back,
Mm-hmm.
right? So it's always open, which is kind of nice for people. Um, it's unlike investing in like private equity, right, where you would have your funds tied up for whatever, maybe it's like 5 or 7 year holding period. In a fund, it's redeemable. So that's like, it's favorable in some respects for investors, but it's a problem as well because human psychology
Yeah.
gets in the way, and people tend to want out at the worst times and want in at the worst times, right? Like you people panic when the market's going down, right? And they want you to sell, and then you're like forced to take a loss at the bottom. um, right. And so you sort of have this like double negative, like of both declining asset values and people redeeming in a downturn, which
Yeah.
is why a lot of funds struggle. Um, but obviously on the other side, you can grow really quickly, right? Because you have asset growth and investors looking to pile in. Um, but there's ways to structure it, right? Like I think you're sort of free to do what you want in terms of um, some people have like lockups, right? So maybe 90 days or no redemptions in the first year. There's ways of structuring it. And, I think over the long term, what a lot of people try to do is have, and we can talk about this because I think it's something that's sort of underrated in investing, but like a focus on like structure. Like a lot of people don't really think about how to structure things. I think that's why you see like a lot of um, people who have had a lot of success try to find like some permanent capital vehicle, right? So like the most obvious ones, obviously like Warren Buffett at Berkshire, right? It's like you create something where it's like a permanent capital vehicle, and therefore like he doesn't need to redeem his investors, right? Like they just buy and sell their securities on the secondary market, and like I think that enables um, perhaps like more long-term thinking, right, from the allocator's position. Because if you're sort of, I think a reason a lot of funds struggle is because they're always worried about redemption risk. And so you start to prioritize like shorter dated results, right? Like you don't want to have a bad quarter because maybe your investors are going to be like, why are you underperforming this quarter? Right. And they're going to leave. So people, I think it like kind of pollutes the incentives a little bit. But I mean, there's obviously ways out of that. And then obviously when you're a small fund, I think a lot of that is just about making sure your LPs are the right LPs and kind of just understand what you're trying to do. Because if you're investing on like a 3 year horizon or something, right, it's just not going to work if people are scrutinizing every monthly statement that comes out, right? Just like you're not going to be able to capture those like longer dated tails. But I mean, yeah, it's just kind of the way I think about it, right? Is you have, and you see this a lot where like people who have really good track records launch a fund and then all of a sudden the results go down. It's like, why is it
Mhm.
happening? And a lot of it is because you actually start doing different things because you're worried about different incentives. So I've tried to minimize that as much as possible, right? And like, I don't have, for example, like one way you can do it, like I don't have a management fee, so it's just all performance driven. Um, so that's another thing to kind of get investors more aligned with you, right? It's like there's no, you're not paying if you're not making money. There's various ways of structuring it, but yeah.
Okay. And I was just curious, and I guess you already answered, how did the fund perform during the April? Were the people panic telling you, hey, just sell
No,
everything, get rid of,
yeah,
get,
so no. Fortunately, I have good investors, but also, the fund was really new at that point. So it's like pretty unusual for people to be like looking for an exit a few months in. Um, w- we actually had a big drawdown in February. So it was like, for whatever reason, and I think if you kind of invest in like smaller cap value stocks, you would have probably experienced something similar, but like they almost sold off earlier than everything else. So in February, like we actually had a positive April, but then like very negative February, right? So
interesting.
it was fine. Like, it was kind of like underperformed in February, outperformed in April. Like you're gonna get a little bit of uncorrelated outcome as well when you're like in a bunch of more illiquid value stocks
Hmm.
concentrated, right? It's not always gonna like have a lot of beta, but yeah, I mean, I think I think you just kind of set expectations, right? If you have 15 positions and like, even within that, there's concentration at the front end, right? Like the top five or maybe 40%. You're gonna have big swings. So you just have to have like you set expectations for people that that's going to happen, right? Like it's not unusual for us to have months um where we're plus or minus 10, right? Like so it's not the sort of like low volatility like mutual fund structure. It's going to be volatile.
Mm-hmm. And in terms of the fund, I guess the way it works, people need to know in advance your investing strategy. So they need to know that you are investing in small caps, and like people who are more of a retiree, and they come to you and they say, hey, can you do something like invest just in dividend stocks because I just want to get my 5% yield?
Yeah,
You just tell them like, it's not my strategy, right?
it's just not it's just not for you, right? Like because it's I'm trying to create value in the best way I know how to do it, and like it's this way. And if you want, someone to structure you like a nice dividend portfolio, like I'm sure there's someone else you can find, right? It's just not what I'm doing. So, and a lot of like kind of like you see these like big asset management companies where they might have different kinds of funds
Mhm.
within their like that's not what I'm doing, right? It's one entity and it's because of the way I've structured it, I sort of talked about no management fee, and kind of needing investors to be super aligned with what I'm doing. I'm not particularly like this isn't like an AUM machine where I'm like, hey, like I'll just raise another fund so I can like get your capital too and charge you 2% or whatever, right? It's just not what I'm doing. So I'm like, and as everyone should be, but like, pretty upfront with people when I think it's a bad fit. Right? Like, it's just not going to be for everyone. Um, you're gonna, I think, right? Like if you're like retired and you need like some income generation, like you're not gonna put like all your money in my fund, right? Like it's just not right for you. So it depends, but there's always kind of less like you just got to communicate in advance, and I think most people, like most of my partners have some level of sophistication, or and generally because of like I'm not out there like advertising. Um, it's mostly people that have found me, and if they found me, it's probably because they're reading about like investments online, right? So like they probably have some level of sophistication and like insight into what I'm trying to do. So it like usually is a good fit.
Mm-hmm. Yeah, something interesting because the first time I heard about your fund is not from your Twitter, not from your Substack. I just listened to another interview of yours where you mentioned it, and I was like, wow, I didn't know you have your fund.
Yeah,
Interesting.
exactly. Exactly. I don't like, I don't really talk about it much.
Mm-hmm. And in terms of your background, so you said you went to the law school, and how did you learn actually the investing? Because I don't think you learned it at school, right?
No, well, yeah. So in my undergrad, I had an economics major and I took finance classes and stuff. And so I think kind of maybe gave me the language of investing somewhat. Um, but I even think, and I don't know if you went to business school, but like learning stuff like the CAPM formula, like the stuff that they teach in business school is like it's basically useless to invest. Like it's just not. I mean, in fact, like what do they tell you in business school? Sort of like operative like framework is that the market's efficient. So, within the confines of business school, they're effectively telling you like it's useless to even try to be an investor, which obviously makes no sense, but that's like what happens in academia, right? Is it gets like so far removed from what's actually going on the ground. So I don't know like how helpful that even is. Of course, you get an MBA, you can do investing programs and stuff, but that's not what I did. But I basically um have just been interested in the market for a long time and kind of just, I mean, entirely self-taught, right? Like it was just trial and error, I think. you kind of spend some time losing money to figure out what works for you. And initially, I think as with most people, it sort of started out like buying like, I don't know, the Meg 7 stuff, right? Or like Alibaba or something like this, right? And sort of realizing like maybe you make some money because like the direction of the market just trends higher and these are like the big winners, right? And so you think you're a genius, but then something happens, you get like a big downturn and you realize you have no idea what you're doing. So it's just a process of that, right? And then I do think the actually I think this isn't often thought about, but the legal education like really helped accelerate um my like teaching myself investing because a lot of the sort of like analytical skill set is similar. It's like very overlapping, right? So like I mean an example. So I was a litigator. You litigating a case, it was like big corporate clients. You're gonna get like a huge volume of information just thrown on you. And you know, you've got to like sort of pour through that information, extract what's relevant and what isn't, or like what's core, and you sort of craft a thesis around that, right? Like you're trying to say, it's almost like you build like a like a bull case, right? You're like, here's all the information, like what's the best argument I can make for my client? And then on the other side of it, you sort of think, what's the best argument the other side can make? That's the bear case, right? And so you're sort of, it seems weird, but like that's kind of you're doing the same thing. It's just that like the information set is different, right? Like you're not trying to think like what's the company worth, but like in many respects, like I think stuff like valuing companies, which is obviously a unique skill set. It's not something you're going to learn as a lawyer. I don't really think that that's the hard part of investing. Like that stuff you can sort of figure out yourself, right? Like if you care enough, you can like figure out what returns on capital mean, right? Like you don't need really instruction for that. I think the real skill set is in what I just said, right? Sort of like identifying what matters in like a large volume of information and then kind of like extracting that, right? Because it's really easy. And I see investors do this all the time, which I tend to think is probably like a big mistake a lot of people make is they sort of like lose the forest to the trees, right? That's a very classic thing where you almost get fixated on minutia, right? Like can't like pull the trigger on this investment because like this thing. And it's just like, okay, sure, but like does it matter really? Right. Like usually like an investment is going to be driven by like a handful of things, mostly like qualitative things, where you're going to have some like variant perception on what that all means. And nothing else really matters, right? Like, are they going to like uh have a working capital impact in Q3 this year? It's not going to matter. It's like doesn't drive the result of an investment over the long term. And maybe, in this kind of like and moving to a separate sort of, question here, but like I would I would potentially make the argument that going to law school is like better than going to work at a hedge fund or something to be a good investor. And like I know it's like a controversial opinion and it depends on the kind of fund, right? Obviously, but a lot of these like institutional um like analyst roles, right, are gonna get you to um operate within a framework that perhaps um isn't structured around the same objective, right? Like I think a lot of institutions, the goal isn't to maximize returns. The goal is like some risk adjusted, like low volatility thing to like capture AUM, right? And so you start operating in an analytical framework where maybe like what you do is you worry about um are they going to beat the consensus estimate in Q2 and therefore we buy or sell, right? And like you listen to someone like Warren Buffett, right? And it's like that's never what he's thinking about. Right? Like has Buffett ever bought something because he's like they're going to beat the consensus like estimate? Like no. Like that's just not what he's doing. He's thinking about the business, um, and how that's going to create value long term. And so I think sometimes obviously you can go work at like a great fund that does like good value investing, and you're gonna like definitely have a better skill set than like someone who went to law school. But I think a lot of people go work at these institutions where like they're just playing a different game, and then they try to run their own portfolio like in that style where you have basically like no chance of competing against like these like mega institutions with like huge informational edges, right? Like you're just not going to play that game. So I think like one of the big keys is like deciding what game you want to play. Right. So like one of those is like, okay, if you think a little longer term and maybe you buy smaller stocks with less competition, like perhaps this need to have this huge informational edge. Um, well, first you can probably get an informational edge because there's less people looking at it, and then you can like sort of offset any um other deficiencies with like a longer term horizon, right? So like a behavioral edge. A lot of people kind of play a game they can't win. So I think if you just sort of like, you come up in a like a law school education where you're just sort of like learning analytical analysis, it's all you're really doing. And then you go like craft your strategy around that skill set, you could probably have a pretty good investment career. Like, a lot of the best investors I know um did not come from like conventional business school paths. In fact, I would probably say like if I looked at like, I don't know, the 20 investors I admire the most, like they would lean outside of the conventional path. I mean, they come from different like walks of life.
Uh, my background is in a big tech. I'm just working as a developer, and I started doing all the investing through the courses, the online courses through the Yale, through MIT. And then when I understood how to read 10Ks, this is basically what I did. I didn't look at what company does. I just look at their financials and made my decision based on this. And it was terrible. Like my performance
Mhm.
was so much worse than just putting money into the S&P. And then I started
Yeah.
looking at other retail investors like you, like Henry, who are telling me like you need to take a look at what management, who the managers are, what they're saying, what's their long-term vision, what the estimate for the next quarter. And actually, this one clicked to me. I was like, this is that makes so much more sense than just looking at the paper because I am investing not in the paper, not in the 10K. I'm investing in people and the
Exactly.
vision behind the company. Yeah,
Yeah,
you,
that's
you,
right.
you gave a
Yeah.
really good perspective on like not going to like school, but going to law school because you get more understanding of the human psychology, right?
Yeah. I mean, this is, I think there's a few things to unpack there, right? Like I always say, like when people go, everyone loves to go listen to the Berkshire Hathaway like annual meetings, right? And Buffett always says these things and Munger, like, um, which are so simple in
Mhm.
essence, right? Like Buffett will always say something like, and I think this is like kind of the number one key to investing really. So it's always like think like a business owner, right? Like you're buying a business. Um, and people hear that and they're like, yeah, like that, that's what you do. And then they go to their desk and they just don't do that at all, right? Like they're doing the exact opposite. So there's this, I always tell people like listen to like Buffett and like actually like take him literally. Like he literally means what he's saying, right? Because I think people have a tendency to think like, oh, he just says that, but he's actually just this like really high IQ savant doing things that are too complicated for him to even explain to me. And it's like, yeah, he is a high IQ savant, but like a huge when you actually look at what he's doing, it's like these are very simple. And you see this basically, not just in investing, but when you kind of like when you listen to any person who's had like an inordinate amount of success in their field, you often find that they just repeat the same like really simple things over and over and over again. Like if you listen to like a Peter Thiel interview or something, right? It's like this guy just says the same thing in every interview for 20 years. And you start to realize like these people actually just abide with so much discipline to these like very simple first principles, and that's what drives everything, right? So I always tell people like go listen to what they say. Like Buffett has all this like think like a business owner, right? Like try to think long term, whatever. Like there's all these obvious things, and then people just don't do them. And then you had brought another thing up, which is like the psychology aspect, right? And it's like, I think, for example, like I don't know if you've heard like Munger's like famous speech on like the causes of human misjudgment. I don't
Yeah,
know if
yeah,
are you familiar with that?
yeah.
Like, I think that's a more important thing than that's more valuable than like an MBA, right?
Mm-hmm.
Like he's basically telling you like these are the reasons people fail, not just in investing, but in life. And you sort of like I've like listened to this so many times because you sort of see I think if you ingrain yourself enough with what he's saying, you catch yourself falling victim to the same like um, cognitive biases, right? Like we
Mm-hmm.
all do it. It's universal. Um, and so you sort of like what I've sort of come to realize is like, the success in investing comes down to like um, you know, listening to these like very simple first principles and taking them seriously, and then like orientating your psychology so that you can like follow them properly, right? So, really, thing I like to always talk about, right, is if you go on the Forbes list, right, you look at like the richest people in the world, right, like sort of like look at how they got there, and it's like it's never like traded like options contracts and like 1,000x like 0 day to expiry call up. It's just like it's just not really ever the story. It's like usually some person who had a who built equity in like a single enterprise for decades, right? It's
Mm-hmm.
like I don't know, you bought an insurance company or you owned real estate in Manhattan or whatever it might be, right? It's almost always like one or two investments. It's very rare you can see what they did. There's like a category like diversified. It's like very rare that it says that. It's usually like one thing. And like all of these people have like this long-term exposure to one business, right? And like people will say, well, they're like entrepreneurs and it's their company or whatever. And like, sure. But in many instances, like the business that they became billionaires off of was publicly traded, and you could have like ridden their coattails with them, but nobody ever does that, right? Like there's always that story people talk about Walmart, right, where only it was only the Walton family that like ever held the stock, the whole way through. So people
Mm-hmm.
along the way, everyone got in and they got out, and then just the owners became like mega billionaires. But you could have bought it in the 80s with them and rode it through, and you'd be a billionaire, right? But nobody does that. She
Mm-hmm.
sort of, but who does do that is like Buffett occasionally, right? I think he will find something and he'll ride it. And so you kind of look at stories like that, and then you see data where it's like, the average holding period in stocks is like 5.5 months or something like that, right? And it's just like, well, you're doing the exact opposite of what like
Mm-hmm.
the people who make it in this profession like do, right? It's like you can't because you're sort of um it's almost it's a kind of the weird like liquidity thing with stock market, right? I think one way I sort of put it um, is like you know I know a lot more people, and I'm sure you do, who have made their wealth off of real estate than
Mm-hmm.
stocks. Like just the average person, right? I'm not talking like billionaire hedge fund people, but just like the average person who's
Mm-hmm.
done like who's made more money than they probably should have based on like what their career was, have like generated an outsized amount of wealth. It's almost always because they like bought real estate.
Mm-hmm.
And that's interesting because over the long term, stocks return more than real estate. So why are there more people getting rich off a low return asset, right? And
Mm-hmm.
I think the answer is obvious, which is that
Yeah.
people hold real estate. They don't hold the stock, right? So when you have, I mean, we had an example of this in April, right? Where it was like, how many people panic sold their stocks in April at the lows, right? So many, obviously, because we saw what happened in the market. How many people panic sold their like apartment building? Nobody,
No
because
one.
you can't even get out fast enough, right?
Yeah.
So people tend to just um, there's this value I think to having like an illiquid asset for most people because their psychologies are basically like it impedes the ability for you to do stupid things because you can't sell it. Whereas with a stock, you can just like there's an there's an excuse at every minute to get rid of it.
Mm-hmm.
And so therefore you end up doing suboptimal things, right? So I think, people need to sort of like think about, if you think about business ownership and then you like just set your psychology right, and then you just like relax, you probably do okay, right? Like you get 12% a year for a long time. That's better than most people are gonna do. But very few people do it. I mean, almost
Mm-hmm.
nobody even beats the index. Almost nobody even passively indexes, right? Like that's a really interesting thing.
Mm-hmm.
I think if you when I was preparing my like investor presentation, I came across a statistic that like if you had invested in the S&P like passive, just passively like indexed in 1995, so 30 years ago, I think you'd have 20 times your money. Um, but who did that, right? Like I've yet to find anyone who's 20x their money passively indexing. I'm not sure if you've ever seen that before, but I haven't. But it's as
Yeah,
simple as just putting the money away and touching it, right? Like,
I've seen a different statistics that people were looking at the account that underperformed the market, and the reason was that people who hold the account actually died.
yeah, this
Yeah,
is
and
like the
they're
classic fidelity thing. I'm not sure.
yeah,
I've heard that this is not even true, but like even if it's not, it makes sense. I bet
yeah.
you, it's like that's exactly the thing. It's like just don't like I think I don't know, there's a compulsion. This is where like the Munger stuff comes in, right? It's just
Mm-hmm.
like you have to sort of find a way. It's very difficult for people. Like most people, they really just can't because one thing, even just sort of the fear aside, right? Because a lot of times it's like fear, but it's also the like FOMO on the other side. Like it's very hard to own a stock that's not doing anything while there's other things going up. And people on Twitter are like pitching, like, right now it's like there's a big SPAC mania about it's back, right? Everyone's like buying SPACs. And I understand why they're doing it. It's like it's actually good investing because like you have this, depending on what you're buying, but you have this kind of structure that's asymmetric because you get like the trust value and then, maybe they buy some like crypto nonsense and you get like a huge return. So I get what they're doing. Um, but then you have the situation where it's like, say you own I don't know, you bought this company a couple of years ago and maybe you're up 100% on it. So it's been a successful investment. But you think like, this business will do pretty well over time. It could, the management's really good. I understand the company, it's not overvalued, but the stock's just not going anywhere. It's very difficult for people to be like, I'm just going to stick with the company that I own, even though I know it's not going to go up like 100% in the next 3 months. They sell it and then they go chase something and then eventually they get caught on the wrong side of it and that stock that you were up 100% on, like, now you have to pay your capital gains tax and then maybe like you bought something that went down 50% and now you just set back like 3 years of compounding. Like people do
Mm-hmm.
this all the time, right? So that's a really really difficult thing. And I know you wanted to talk about Cipher at some point, but like that's a really good example, right? Where it's like here's this company that I've owned for maybe 3 years
Mm-hmm.
and I'm up significantly on the investment, right? Like I think maybe it's 200 or 300% return at this point. But like for the last year, it's done nothing. Like I
Mm-hmm.
just complete. In fact, it's just gone down
Yep.
pretty much. And so what you start to see is people get less interested in the idea. They start to sell, like it's just because like a lot of people are just investing in the chart and they're like it's flat, right? And meanwhile, there's all this stuff that's going like parabolic. And so you start to ask yourself, like, am I just like, is my opportunity cost of holding this like too high? Like, should I be more nimble and flexible? Like, maybe. But I sort of see like I own a great business with like a management team I trust that has like, I think a lot of upside in the future. And like, I'm content to just like underperform holding that for a while, even though like, yeah, I could probably sell it and buy a SPAC and make more money in the next few months. But then what am I going to do with that? This is the other thing is like when you're doing this, like chasing the themes and stuff, you can make some really good money. But the problem is like, let's say I sell Cipher, I buy a SPAC doubles, I get out of the SPAC. And I have to figure out what to do with the money. I got to go find a new investment. And at some point down the road, I'm probably going to get it wrong.
Mm-hmm.
And maybe I sell Cipher, the SPAC doubles, I buy something else, it gets cut in half. I'm back to where I was when I just bought Cipher. I could just spelled Cipher and not paid any tax, right? Like, so I don't know. I think people, and if you owned like something in the private market that was doing really well, and there's no stock chart, right? Like there is no chart. It's
Mm-hmm.
just like I own the business, it's doing well, the income's growing. You're not gonna like sell it just because like some chart is going higher, right? Like that's just not how. And like it goes back to the Forbes thing. Like this is not people in like the Forbes list invest, right? They don't like say I need to like sell my apartment complexes because like it's not going up this year, right? Like there, I think again, a lot of people sort of invest in charts. Like this, the public markets does something to people's psychology, which like makes their decision making really poor. If you sort of just ignore the chart and you just like think about the business, like growing its income, it's not overvalued. There's a big runway.
Yeah.
You're gonna do.
The
I think you're gonna do pretty well, right? Maybe you're not gonna put up like Warren Buffett numbers, but you're gonna do fine. And for
yeah,
most people, like doing fine over a long, I mean, for everyone, doing fine over a long period of time is really good, right? It's better than most people can say.
technical analysis never clicked on my head. I just understand that investing in business makes sense, but looking at the chart and looking at the patterns, it's just like gambling. And yeah, I'm glad I didn't went through this path and just went through investing. In
Yeah.
terms of the Cipher, yeah, let's
Mm.
talk about it. Can you tell me what this company do and actually how you found it? Because it's a really small cap Canadian listed company, and I'm pretty much sure everyone from US and international investor never heard of this company before.
Sure. Yeah. So Cipher is a Canadian company, um, and it's a specialty pharmaceutical company, right? So what they do, and the focus has narrowed into mostly dermatology products. So they're like commercialized um, dermatology products. So like their sort of like main product is something called Ipurus in Canada, which is a for the treatment of acne. And then they will take those products and they'll like license them out globally if they can. And so basically, what you have is a very, very high margin business. It's almost like a royalty company, is kind of the way I think about it. Um, that is selling products in spaces that are not particularly competitive, right? And so you kind of have, so we're going to talk about a purse. That's like the core one. Maybe it's like 70% gross margins, maybe a little bit lower on that product. But it's just this like, it's a cash machine, right? Because there is no, there's basically no reinvestment that this is something, I think if you're sort of like a beginning investor, something you have to think about a lot is like company makes money, right? But then what do they do with that money? Like what has to happen, right? So if you like operate a retailer, you make a bunch of money. Like that's not necessarily like free cash flow because you have to like take that money and then buy your inventory for like the
Mhm.
next season, right? And so you're constantly having this like need for your cash to go back into the business in some way. Something like Cipher doesn't have that, right? Because they basically just have the rights to these products. They sell it. There's a very low cost of goods sold, where it's like your inventory. And then that's it, right? There's no warehouses, there's no like massive leases they have to pay. And so they take this money and they have nothing to do with it, right? It's very asset light, earns super high returns on capital. Um, and it enables them basically, you can really think about this like truly as like a business where it's like that cash is mine. It's like distributable, right? So they can either return the capital or they can take the capital and buy new products, right? So I'm getting a little bit ahead of myself, but I think it's kind of like the really interesting thing about the business. You said like, where did I find it? So I think, it might have been, I think there was somebody wrote the company up on the Value Investors Club way back 3 years ago or so. And at the time, it was an interesting situation because you essentially had, and there's some really good patterns here that I think are like worthwhile to like pay attention to, and something I look for a lot. But essentially, you had this company. It was founded by it's this guy called John Mall. It was like spun out of another entity, and they had some success, and then they brought in like a third party CEO. So the Mall family like owned, most of this, I don't know, 40% of the company or something, call it, right? They brought in an external like third party CEO. They had this product called Absorica. Okay. Absorica is the same thing as Icarus, but the US licensed version. So this asset's making a ton of money. And they're doing that, there's nothing to do with the cash. So they start buying other assets. Um, Unfortunately, like two bad things happened at the same time. First was that they made some bad acquisitions, right? So they kind of made more speculative, like, these companies weren't, maybe the products weren't really commercialized yet, or they overpaid for them, took on some debt to buy them. And at the same time, Absorica hit its like patent cliff in the US. And so the revenue immediately declined like really aggressively because the generics could come in and take the space from them, right? So you had declining revenues, and then you had a deteriorating balance sheet because you levered up to buy things that weren't contributing to cash flow, and the stock just collapsed. I think maybe it was like $15 to $20, and it went down to like below $1 at the bottom in COVID. Um, they bring back, or they hire who's the current CEO, Craig Mall, the son of John Mall, and he's super aligned, like they coming up on almost 50% ownership. And he comes in and sort of like figures out how to turn this business around, right? So cutting costs, right? They improve the margins, and then the Absorica declines end up getting offset by Epirus. So they work on the commercialization of this product in Canada. And so that revenue stream starts to build as the other one declines, and you have this like good co bad co thing, which is something I think is always worth looking for, right? You sort of see like as the main revenue stream gets smaller and smaller, its declines matter less and less when you have another earning stream growing. So that often gets masked because at the beginning, the declining business is bigger. And so every year when they report results, you're going to see lower revenue or lower income. But at a certain point, there's it sort of crosses over, and that sort of like new growing revenue stream becomes a bigger part of the company. And so what looks like a declining business is now a growing one. So that's sort of what happened. This is sort of what's going on when I'm looking at the business. And at the same time, they have a lot of cash. So I don't remember exactly today, but like you basically had a situation where I think it was like $3. I think the stock was $3 a share. Maybe you had $2 of share in cash. And remember, this is a business that doesn't need cash to operate. So you can sort of think of that as like excess cash. So you think like, if you exclude the cash, maybe you're buying the business for $1, and maybe they were going to earn like 50 cents of free cash flow from like uh, the core business, like the Epirus business. So you're buying it for like what, two times free cash flow, right? So you're sort of like a 50% yield. And because there's not a lot of need for the money in the business, you can almost think about that like a bond coupon, right? It's like you're going to get 50% return. Your cash is going to grow by 50%, right? So that's kind of happening. And, that's why I started buying because, one of the things in a situation like that is like you have this huge margin of safety, right? Because you have all this cash sitting there. So how do you like lose money unless the cash gets deployed in a destructive way? And so, that's when I kind of started getting involved in it. And then, it's a really good story because the business keeps evolving through these different things. But, after that, they announced sometime down the road a like tender offer. So they took some of that cash and they said, we're going to buy, I don't know if maybe it was 5 or 10% of the shares outstanding with the cash at like something in the $4 range. Um, and so people were like, that's great because you have this thing trading at two times cash flow that's now buying its stock back. That's very accretive on like a per share basis. Um, but within that, so when they announce the tender offer, there's like a document, they have like a prospectus. And in that prospectus, there was something that was super interesting. So they had this product that they had acquired um, back in the day, which was um, a clinical stage product for the treatment of nail fungus, which was like run by this company called Moberg. The trials are
Hmm.
being run by Moberg in Sweden. Um, and as a result of that, they had basically this valuation table where they said, like, in the prospectus, you have to give like some valuation of your company. And they basically said, when this product gets commercialized, our operating income will be something like 35 million US, which was like, I don't know what the enterprise value at the time was, but maybe it was like 100 million.
Hmm.
So you're like, holy shit, this thing is like, 3 times earnings and growing in a couple of years, really cheap. So then people started to get really excited. The stock went up maybe to 8. Um, and then, they took all this, they had been generating all this cash, and they bought a US business, which is called Natroba. Well, Parapro is the business with their asset, Natroba. So this is like a new product. It's for the treatment of like scabies and lice. So it's like an anti-parasitic. As boring of a business as you can imagine, right? But these are really interesting because um, they paid a good price for it, and there's a lot of growth potential. And it gave them a US business, which creates some really interesting strategic things. But so before I get into that, this Moberg product, the nail fungus one, it actually ends up failing. So the thing that gets a lot of people excited doesn't work out. The stock goes down a bit, but the thing is a lot of that, and this is where really good capital allocation comes into play. It's like a lot of that sort of disappointment, I think, at least, is offset by this new acquisition. So you sort of fast forward, I think stock went from 3 after the deal, and while the nail fungus product was still like in play, the stock hit as high as 19, right? So you start with this like almost like deep value cash shell, and it goes from 3 to 19, right? Like this is like unbelievable, like explosive multi-bagger upside. And this is all in the course of 2 years. Then it basically gets cut in half because the nail fungus thing busts and people got really energized by it, like a certain online community. And like, I think they didn't really understand like that there was value to this outside of that piece. Like they were sort of excited for this sort of like biotechy angle, which never played out. But, so then the stock sells off. Now it's at like, you know, goes down to as low as 10 and currently it's at about $12, right?
Hmm.
And so what's happened now is you have this big turnover in shareholders that happens over time, right? You sort of start with, when I'm buying it at $3, it's like what I would call deep value. It's like you can't really lose money here. Who
Hmm.
knows what's going to happen? But if they do some good things with the cash, you make a bit of money and it's very hard to lose, right? So that ends up happening. Then you get into this kind of like, wow, there's like this speculative like nail fungus asset, which could like, if it works, it could be huge. You get into this almost more like venture sort of situation that fails. Now you have a new company, which is basically this like it's almost what I would consider like it's almost like GARPy. It's like a growth at a reasonable price kind of stock. And so to kind of
Hmm.
explain why it's growing, but like I think what happens a lot of times in these when you get a business like this is the story starts to evolve, right? And a lot of people in the register get in and they get out because like maybe they just do deep value or maybe they just do like growth, whatever. And like, hey, that's whatever, people can do whatever style they want, and that makes sense to be disciplined that way. But my sort of view here has always just been like it's like a sidecar investment. Like I'm investing alongside a CEO who has 50% of the shares and like really cares about creating value and like is super aligned, right? And has a vehicle that allows him to allocate capital in a way. Because again, to go back to what I've been saying, like the business doesn't need any reinvestment. So he can do what he wants with that cash. And if you trust him to do a good job, you're probably going to do well over the long term. So, we're at this point now where the Natroba business that they acquired is very interesting because it's actually higher margin than the acne business, the Apertis
Hmm.
business. And they basically have, they have like 25% market share in the US, but the sort of main treatment for these parasitic conditions is called permethrin.
Mm-hmm.
And essentially, the parasites have um, developed resistance to
Oh.
permethrin. So it just doesn't work.
Mm-hmm.
Okay. So you have this opportunity to capture a huge amount of the market just by getting information out there that, like, hey, like this competitor product actually works and the other one doesn't. And so one thing that the company's been doing is like working on the sales force and kind of like, getting that awareness out there. So there's this huge market share capture opportunity, and they just got recognized in Illinois. It's like a preferred Medicaid notice, which basically said like Natroba is the preferred treatment, and actually the other one, which is interesting, she says the other one's like not effective. So that's like really a big deal, but nobody seemed to really care that much. But if they start doing that, you'll see a lot of incremental gains in market share. And they also have this ability to internationalize it, if that's a word. So basically, like they can bring that revenue stream, they can bring that product to Canada and then license it out internationally. And that's all very high margin stuff. But again, like everything in business, there's like a hang up. So, and this is the part of holding a stock for the long term is there's just always going to be some sort of like hiccup, and like people will get overly negative or whatever, right? Like they'll sort of lose the story. So what happens is, recently is there is a Trump executive order that comes out. Um, well, at least it's like I don't know if it's a real executive order or a proposed one, but it lacks a lot of clarity, as a lot of things that they've done in this administration, right? But like basically, there's this thing. It's like most favored nation status about pharma. So the idea is roughly like if you're selling a product, a pharmaceutical product in the US, you cannot charge more for that product. Sorry, you cannot charge more for that product in the US than you do for that product in other OECD countries. So you can't go commercialize this thing in Canada, for example, and the Canadian pays less than the Americans. What they'll do is they'll find a way to sort of like they'll tax you or they'll reduce the cost in the
Mm.
US. And so that's basically sort of put a pause on the international opportunity. What
Mm.
we don't know what's going to happen, right? But then the company wants to proceed really cautiously about that. And so investors are now like, wow, yeah, like this huge growth angle is gone, right? But okay, sure. But they have this huge one in America, right? So like they still have, so that's kind of what I was talking about earlier about how like in like you got to be able to sort of analyze information and be like, what actually matters more. And
Mm.
it's like, yeah, sure, maybe they lost some of the international stuff for now. We don't even know if this is going to be like a real order. And there's a ton of stuff online about how like maybe you need legislation and like it's really complicated to enforce. And obviously the pharma lobby is enormous in the US. So, I don't know. My guess, if I had to guess, is that none of this is ever going to come to anything. But for now, it's on pause. But you're buying something right now that's kind of at 10 times free cash flow, and they have this huge growth opportunity just in the US. Um, and you have a CEO who's like determined to create this like massive company. And so now they're starting to buy back shares again. They were doing that at four, now they're back to doing it again here.
Mm.
And they'll look for another acquisition. And the other acquisition will be interesting because um, they have basically an underutilized like fixed cost structure, right? So they're basically have these like, fixed sales force expenses, and that sales force could handle another product without any like incremental hires, right? So basically you buy something for its gross margin, and that gross margin is just your like profit because it's just gonna you're gonna utilize the same fixed cost structure. So you have like this huge like this accretive possibility of just like bolting on new products, which makes for a really interesting M&A machine. So there's a lot of ways to win here, right? But people have kind of gone bored about the stock because after peaking at whatever 19 in August, it's at 12 and it hasn't done anything, right? So
Mm.
you're kind of in this waiting phase. But all these big winners, from my experience, they have big runs in a really short period of time and then they stop. and then it sort of consolidates and things change and like there's ups and downs, and then they'll do another big move, right? And so you never know
Mm-hmm.
when that move's gonna come. Like any day now, they could be like, we bought a new product, right? Bang. And you're like, so I sort of look at something like this and it's like, why do I need to sell it? Even though it's like, maybe in the next 3 months or whatever, it's not going to do much, but like it's
Mm-hmm.
a good business. The guy, people running it are trustworthy. It's fairly easy to understand. So yeah, I mean, it's just like this kind of thing for me, I think you just stick with,
Mm-hmm.
um, and you just have patience because it probably works over time. I don't know, I've said a lot there, but
Yeah, it's a good story. I just wanted to clarify a few things. So for a pharma, so this company has a high margin, but for example, their acne business, usually pharma have to spend on research and development, right? So did they come up with the acne solution themselves or they just bought it from someone else?
exactly. So this is what kind of makes the business interesting, right? And you're
Mm-hmm.
right to sort of identify that. Like a lot of these pharma companies might look sort of like um maybe asset light, but then they have like this huge R&D expense, right?
Yeah.
And Cipher doesn't have that either. So when I say like literally like they're not investing the cash into the business, like they're not doing the R&D. They're just acquiring approved products
Mm-hmm.
from some entity, right? So um someone else comes up with the product and they say, hey, we will pay you whatever X dollars for the rights to that product in Canada. And then they'll commercialize it there.
Mm-hmm.
Or like they'll be like on a license or whatever. There's different ways of structuring the deals, but they aren't funding the R&D. So that's
Mm-hmm.
like a huge part of the business model, right? And what makes it really interesting is you don't take on that development risk. And they're usually targeting, and some of the things that they got in trouble with in the past was they would buy clinical stage assets, which may or
Mm-hmm.
may not work. I think the focus now is like pretty much just on buying things that already generate um, revenue, like already commercialized products. And they're
Mm-hmm.
going to be in like boring industries. So, something like lice and scabies, like, it's a big enough market for these guys for it to make a difference. But like, it's not like a market where like Pfizer is going to like buy this, right? It's not going to move the needle, right?
Yeah.
Like, I think they
$40
make,
million of revenue for Pfizer. It's like
yeah,
nothing.
exactly. Like, I think what they Cipher makes 25 million with, with 25 million, 25% of the share. So it's like maybe it's like a slightly over $100 million market.
Mm-hmm.
It's just not like it's not crazy for these guys to be like they don't really like Pfizer doesn't need to go out of its way to get like whatever 50 mil of EBITDA
Mm-hmm.
on this like thing that's not what it does, right? So it's just like there's less competition for these assets. And so the reason that's helpful, like is when you're doing a roll-up strategy like this, right? Like I sort of view Cipher as this really great acquisition vehicle because the multiples on these assets I tend to be pretty low. Like maybe they can buy something for like 5 or 7 times EBITDA or something. I think they paid 7 for Natroba.
Mm-hmm.
Now Cipher, because of I think building credibility and sort of people realizing the mechanics of this, it trades for like 10 times EBITDA, right? And
Mm-hmm.
so there's this sort of multiple arbitrage where like you buy for 7, you get valued at 10 immediately. So you're creating equity value this moment you do it. But also what it enables them to do is to use their stock as currency to finance an acquisition. So they did that for Natroba.
Mm-hmm.
So this is like a really great example of the capital allocation is like, and again, right, there's no use for the cash. So they're building up all this cash on these products. There's only really two things you can do. You can return the money, or you
Yep.
can buy something, or you can just hoard it on your balance sheet, I guess. Right. So Cipher has this like um a lot of cash to use. They're very undercapitalized. Like they took a bit of debt out to buy Natroba, and almost all of
Mm-hmm.
that's paid down now. And then they have their equity, which they can use. And so what you've seen them do really intelligently, I think I mentioned how they did that tender offer early on when the stock was 4, right? So they
Mm-hmm.
bought back a bunch of shares. I think they bought like over 1 million shares, maybe 1.5 million shares back at 4. And then they issued almost the same amount of shares at 9.
Wow,
to
that's
help
smart.
finance the Natroba acquisition, right? So this is like literally you're buying low and you're selling high, right?
Yeah.
And then they did that, and now they're starting to buy back stock again at 12.
Mm-hmm.
And I think what you'll see is probably that they will continue to do that. I think they'll be buying back a lot of shares down here.
Mm-hmm.
And because they have enough liquidity because of how much cash they generate, and because they don't have really any debt anymore, where they can both simultaneously plow their cash into share repurchases and
Mm-hmm.
finance an acquisition with like some debt. And if you start getting the share price up because of the repurchases, well, now your equity starts to become a currency again. And
Mm-hmm.
so if you have a capital allocator helming a business like this, you can create so much value because of the way it's just kind of like structured. It's almost like financial engineering, right?
Mm-hmm.
And then yeah, like I was saying about the underutilized fixed cost structure, you could buy something at 7 times EBITDA,
Mm-hmm.
but then you have this huge cost synergy because you're folding it onto a pre-existing cost basis. So maybe that 7 times EBITDA is actually like two or
Mm-hmm.
whatever, right? It might be much, much cheaper because you've taken all the costs out of the acquired business and just folding them onto costs that you already have.
Mm-hmm.
So you create a lot of value that way. And like, so like this is a company that's like mentioned that they want to do like a NASDAQ listing. Okay. And it's like a 200, give or take $200 million enterprise value. And they're doing, maybe like 25 million of EBITDA in USD. And they're sort of like, well, we'll think about the NASDAQ listing at like 75 million EBITDA. So this is a company that's like already thinking about like how they're going to triple their earnings uh and like go on the NASDAQ at that point. Like they have a real like long-term vision here, right?
Mm-hmm.
And you've got like you got a CEO who owns like whatever $100 million US worth of stock. That was like almost 200 recently. And so
Mm-hmm.
there's a huge amount of skin in the game.
So, I guess as a company doesn't spend money on research and development, the only thing they do to enhance the company is promoting the product, right? They have to spend their own money to promote it into the like US to
Exactly.
increase in Natroba market share.
Yeah.
Okay.
That's right. So you have like a sales force, right? So
Mm-hmm.
that's pretty much what you're trying to do is like, yeah, you're trying to expand your market share,
Mm-hmm.
and you're using your sort of sales force to do that, right? So you're
Okay.
targeting like dermatology offices.
Mm-hmm.
And that's what you can sort of think about as the like use of capital to run the business, right? Like you do have to like pay like a sales force and like there's some inventory and stuff, but so that as light as you're gonna get, right?
Mm-hmm. And under the old CEO, the company folded because one of their drugs, the main drug, went generic. So with the new management, with the CEO who controls 50% of the shares, with Natroba, are they
Yeah.
still having the same kind of risks that the drug can go generic?
Yeah. So you still have that, right? So I think Natroba goes like off patent for scabies, like I think it's 2033.
Mm-hmm.
So you have what, 7, 8 years.
Yep.
And so this is not a perfect business, and this is why exactly for this question, right? Like, a perfect business is like a stock exchange where like
Mm.
they have no reinvestment
Yeah.
needs, but
High
also like
margins.
there's no terminal value, right? So you do have like a terminal value risk with this company because the products face a patent cliff in like generic competition, right? But if you buy them well, yeah, so you say, can't remember what they paid for um Natroba, but maybe I want to say it's 90 million. Okay.
Mm-hmm.
And so you sort of think like, okay, you bought this in 2024 at 90 million. And you've got like 9 years, like, and they're making like, maybe 15 mil of EBITDA. And when I say
Mm-hmm.
EBITDA, people always kind of like roll their eyes, but like in this context of this business, it makes a lot of sense because there's no capex, and like they have meaningful tax loss carry forward, so they're not really paying tax.
Hmm.
And there's like minimal interest expense. So your EBITDA is like basically a proxy for free cash flow. I know people like kind of always like shake their head at that, but it's like I think it's like a true measure of the cash creation in this business. Um, you're maybe you're making like 15 million a year from that product and it's growing.
Hmm.
So the objective is always, of course, like your return on capital, right? So you're gonna pay 90. What are you gonna make for this investment over the duration of when you
Hmm.
have like the patent protection? And it seems like it's completely obvious to me that this is going to turn into a really good deal on like an ROIC basis. And then the mandate for a business like this, and this is why there's always sort of like a leading man risk, and like as I said, it's not perfect business. It's because you do have to take that money that you make from this product and find a way to buy something else. And you have to like keep it going because you have terminal risk with the products. Now, it's not always, if you look at something like Epirus, the Canadian product, right? Like there's already a generic market in Canada for this, and they still have
Hmm.
dominant market share. And so
Wow.
like, in Absorica, which is their US, so Absorica still exists.
Hmm.
Like, you don't go to zero. So you continue to make money on these things. It's just that like the huge amount of money you make declines. But you can offset that perhaps with like good acquisitions, right? So the idea is you start building this like fortress of a portfolio with more and more products get bolted on, right? And so, the very there's a famous, I don't know, are you familiar with Valiant, like the famous like company that blew up that Bill Ackman invested in?
Yeah, yeah.
So, Valiant was basically running this business model. So people are going to be like, well, that worked out terribly, but like there was like fraud going on there. But that was the idea with something like Valiant as well, where it was like we have this really interesting like M&A machine because
Hmm.
of like the way these dynamics I've laid out work. But if you don't bite off more than you can chew and like you're not like committing fraud, like this can be a really good vehicle.
Hmm.
Because you've already seen the value that they create. Like, it's went from 3 to the mid-teens, basically on the heels of like some buybacks and an acquisition in a couple years. As you start to grow, um, you have more like you have more liquidity available for bigger and bigger deals. And so you just constantly diversifying away the risk of any one product getting competed away. So you still remain at this point in time, like, yeah, there's like if they went out, if the company went out right now and they like took all the cash flows and they bought like some terrible thing that didn't generate any money, you're gonna get into trouble because like eventually you're gonna lose the cash flows that you have today.
Hmm.
And then this is sort of basically what happened 10 years ago, right? Is like you start to lose the cash flow
Yeah.
just as you have like this you're kind of like you have interest expense on your balance sheet because you levered up to buy something and now like your cash flows are declining and your debt service is increasing and the thing that you bought isn't contributing, like you're
Hmm.
going to blow up the business. But these guys, I mean, they know the mandate. Like again, like it's like you have $100 million of your own money in the company.
Yeah.
Everything they've done has been really conservative. Like some people are like annoyed right now because they haven't bought the next asset yet, even though they you know, maybe in late 24, early 25, there was some commentary on the conference calls, like they were getting close to a deal, and it hasn't happened yet, and people get frustrated. But like to me, that's a good thing. Like I don't want like the management team just like buying something just because they need to buy it. And
Hmm.
so they're waiting for something good. And like I don't know, I'm pretty like there's always gonna be risks in an investment, but like you got 8 years on a growing asset, and then you have the core the Purse business, which is still growing as well. You're trading at like 10 times free cash flow, and that number's that's shrinking over time because your free cash flow is growing. You're buying back stock. Like I consider this personally like an investment. Like I would like sleep very well at night, like
Hmm.
holding, and that's why it's like a 12% position for us, right? Like it's a
Hmm.
big position because you know structuring like a portfolio, I think sort of like a barbell, right? You have like maybe these sort of like core, so like what I call like backbone positions where it's like this is just like, maybe it's not going to have like rip your face off upside. Like I have other things in my portfolio that like almost certainly have more upside. But like I don't I can sleep well at night with Cipher and it probably
Hmm.
beats the market. Like I'm pretty confident it'll beat the market. And it could actually have a lot of upside, but like you're just sort of like you can like yeah, maybe you get 15-20% a year on a 10% position. Pretty good. You can like sleep well at night with
Yep.
that. Uh rather than having like I own something called like AST Space Mobile, which is like I think, it has like an enormous amount of upside. It's like kind of it's been on this huge run recently.
Hmm.
But like, do I want to have that as my biggest position? Like, maybe it'll like if it works, that would be a genius move. But like, I just think that having something that has like meaningful downside is like
Hmm.
not the way to size positions, right? Like, I think Joel
Yep.
Greenblatt kind of had this idea where it was like you want to think about sizing based on how much money you can lose. And with something like Cipher, I just don't really see how you lose money,
Hmm.
right? Like you always could, but at $12 a share, like I'm pretty comfortable owning this in size.
Do you think it's fair to say that Cipher is a Constellation Software of pharma industry?
Yeah, well, I mean, I think maybe that's a little bit too generous. I think like they're doing something similar,
Hmm.
obviously. There's no doubt about it. I think by nature of what Constellation's end market is, like there's way more opportunity. Like Cipher's not going to become a whatever multi-hundred-billion-dollar
Hmm.
business, just not going to happen. So like what happened with Constellation that was obviously incredible is the ability to like reinvest money in acquisitions at like very high returns on capital for like a super super long time. It gets tougher with something like Cipher where it's like the opportunity set is smaller, and I think there's probably decreasing returns to scale, right? Like one thing that Constellation sort of defied the odds with, I think, is like as it got bigger, it was still able to like generate really high returns on reinvestment,
Hmm.
because they were able to grow the businesses that they owned, and then they were able to sort of like scale up in the size or just do more deals, right? Because it gets harder, right? With a company like Cipher, like you know, I sort of see like I think this can be $1 billion company. It's
Hmm.
like 200 million today, right? Like that's sort of like so there's a world in which they get to a billion, it's 100 mil of EBITDA at 10x or something. I think at that point, it starts to become maybe a bit more difficult to do what they're doing because you're going to
Hmm.
start getting into like more competitive
Yep.
products. And it's not the kind of business where you could just do like, well, we'll buy 10 things that do like 2 mil of EBITDA or something. Like it's just there's the opportunity set like that doesn't exist.
Hmm.
So as you start to move up, I think it gets a lot harder for them. But you sort of hope by that point, and who knows, right? Like that's a long way away, but there's like a steady state where maybe it becomes like a dividend payer, right?
Hmm.
Like it might be something like that. Or like I think what you can do, and you've seen like some of the great capital allocators do this over time, right? Is like you actually just you find a way to like shrink your business and still create per share value, right? So like let's obviously like the buyback is what you do
Hmm.
that with, but there's ways for them to maybe like return a lot of capital so that like they can stay small and keep doing this. And that's maybe the way to do it. Because I
Hmm.
just don't think that this is like a company where you can, and maybe I'm just dead wrong about this, but like I don't think this is a company where you can like creatively deploy capital at like a huge market capitalization.
Hmm.
But that's fine, right? Like people forget that like they can just return money and then you just like kind of start again. Right? Like businesses do this. And I think when you have a CEO who's aligned well, because what happens a lot of times, right, is like you have a CEO who doesn't own a lot of stock and like their compensation is set based on like the size of the business. And so their incentive is just like grow, grow, grow. Like it's very hard to get a CEO to like shrink their enterprise. But
Hmm.
when you are an owner, like you don't care about the size of your business, you care about like your per share value, right? So I think you might have a situation in a company like this where it's like, hey, we'll just like return a bunch of capital and then stay small and keep going, and that's great, right? who
Mm-hmm.
knows what'll happen. But yeah, I think it could be a world if they do things well. Like let's say they get to 50 or 75 mil of EBITDA, right? Like one day, and like the share count stays kind of the same. Like um you can have like maybe like $3 of like dividends paid out a year, right? And that's a
Mm-hmm.
$12, right? And actually it's more than that because I'm not even converting back to Canadian. So maybe you can make $5 a share
Mm-hmm.
in capital returns and you're paying 12 today.
Yeah.
So it's like a really nice yield down the road. And I think this is another thing people like lose sight of a lot, right? But like um if you buy a stock for $3
Mm-hmm.
and then in 5 years it pays you $3 a share in dividends,
Yeah.
who cares if the stock isn't going up a lot because you're
Yeah.
making infinite returns. Like you got all
Yeah.
your money back. But like this is the thing that people always gave like Buffett shit about like he should have sold Coca-Cola a long time ago
Mm-hmm.
because like the stock didn't do much. You sort of think about it and it's like, he's getting back in dividends what he paid for like 40
Yeah.
years ago. Like, why do you need to sell it? Like, I understand you have like limited capital appreciation, but like your basis is zero, right?
Mm-hmm.
You've had all your money returned to you. Now you just get this like, you know, this check forever.
Mm-hmm.
It's like an infinite return investment. Like I think people sometimes don't think about this enough. Like if you buy something for low enough and then that thing returns money to you in the future, like the stock doesn't need to keep going up a lot. It's like you're making 100% yield on what you paid, like for a long time.
Mm-hmm.
Uh, so maybe you get something like that. It's definitely possible. There's a company, and they're actually smaller, but Bioscience, which is another Canadian uh, specialty pharma company.
Mm-hmm.
They're actually not as big as Cipher, but you can sort of see like what's happened to that business. Like it was like a fifth, like if you go back to, I'm just looking at the chart here, like if you go back to like 2011, it's like a 10-cent stock.
Mm-hmm.
It's $11 now,
Wow.
and they pay a 2% dividend, but because it's a 100 bagger, like if you had bought it then, that dividend is more than you put in.
Mm-hmm.
Well, the stock hasn't done much for a long time, but like who needs it to, right? If you bought
Yeah.
it, it's that low. I think so. I don't know. Maybe there's a situation like that one day. Like I think it's one of these like I said, it's like a sidecar investment. Like you're sort of putting your trust. The way I sort of like think about it with I say this to my partners is like you're giving me like you're delegating your capital to me to allocate. And
Mm-hmm.
I am in turn doing the same thing when I buy a company like Cipher, right? Like I am basically giving my money to Cipher, my partner's money, and we're saying like you do what you're gonna do, right? Like this is you're in control. This is your business. Like here's some money.
Mm-hmm.
And so you just kind of like trust in like the allocator um to do the right things. And you have no like when I bought Cipher at $3, I didn't know they were gonna like buy this US business.
Mm-hmm.
Right. Like that wasn't part of my like underwriting because you can't underwrite the
Yeah.
unknowable.
You just
But
need to trust management.
he created so much value, right? Like I didn't
Mm-hmm.
see that coming. But if you buy things cheap with the right owners, um, and like the right incentives, you're probably gonna do okay because they'll find a way to
Mm-hmm.
create value for you, right?
Uh, I guess the last question I want to ask about Cipher is about the Moberg and the fungus drug. So you said it failed, but did it really fail or just the Moberg need to
So
adjust the doses?
yeah, so it's probably not the right word to say that it failed, but basically the results of the trial that they ran in the US, um, and look, I'm not like an expert on this, but it basically it reduce like it's about labeling, right? So
Mm-hmm.
they cannot use a label that would make it marketable in a way that's better than like the pre-existing product on the
Okay.
market. And so like kind of leaving the US aside, like this sort of started like people were like, well, they can still commercialize in Canada because there is
Mm-hmm.
approval for the product in Europe.
Yep.
Um, and Cipher's kind of view on it as well. There's just no point in like doing this because of the label. Some people may disagree with that, but like I kind of tend to trust that like they're not gonna pass up on a big money making opportunity if they thought it was one, right? So,
Mm-hmm.
and what happened, like as you know, is this kind of became like a mania online with
Yep.
this product, and there's still a lot of people out there, despite my like endless commentary suggesting otherwise, that think that like you buy this company because like this nail fungus thing is going to work.
Mm-hmm.
And it's like, no, like you like people need to like give up on that being part of the thesis. And that's definitely led to some compression in the share price.
Mm-hmm.
Because I think people recognizing that and getting out because people want this goes back to what I was saying at the beginning of this conversation, but like people want like this like explosive upside and like they have like FOMO, right? So if you say like, hey, this big catalyst that you thought was coming isn't coming anymore, and then
The
you
share
have all
price
these
growth.
other stocks going up all the time, they're going to sell and go buy the other
Yeah.
stocks, right? Because they don't want to wait for like them to take Natroba market share growth in the US. It's like
Mm-hmm.
boring, right? Like owning the stock is so boring.
Yeah.
Um, but like that's how you make money, right? I mean, it's just like
Mm-hmm.
there's like I don't know, you know, like look at all the big winners out there, these like huge compounders and stuff, right? And it's just like it's almost always boring, right? It's just like incremental gains and occasionally a big move, and you just hold it. Um, my favorite story about this is Steve Ballmer, the Microsoft guy. I mean, obviously you're familiar, but it's like um, Mike, like he is richer than Bill Gates because he
Yeah.
never sold his
He
Microsoft
knows.
stock.
Yeah.
But there was a period in time, after the dot-com bubble,
Mm-hmm.
where like the Microsoft stock did nothing. I think it was like 15 years or
Yeah.
something. You would
A
have
lot of
made no,
fears.
right?
Mm-hmm.
Right? How does one have that kind of patience,
Mm-hmm.
right? To just be like, I haven't made any money on my biggest investment for 15 years, and I'm just gonna sit there,
Mm-hmm.
right? Like now, obviously, you have to be right about the company over the long term, or that's just terrible investing. But like the point is just like most people can't even wait like 6 months for like the earnings to start inflecting, right? And
Mm-hmm.
here you have a guy who's like, top 10 on the Forbes list who just like he had his stock go nowhere for like 15
15
years.
years.
Nobody sat through that. And like this Ballmer is like an extreme example because he was the CEO over that
Mm-hmm.
period, right? But like how many people held Microsoft through that in the world? Like probably no one.
Yeah.
But if you did, you'd be like, you'd be retired on a beach somewhere, but nobody did it. So I
Mm-hmm.
just think like you got to fight this like boredom thing, like go find something to do. And if you sort of think about get to know the management teams, think about the business, don't look at the stock price all the time. Think about like what are they doing?
Mm-hmm.
It gets a lot easier to hold because you're sort of like, I see, speak to the companies. It's like I see like Natroba is growing and there's this really interesting opportunity. Things don't happen overnight. That's the other thing. I think a lot of investors like plug things into their spreadsheet and then they don't realize that like that's not how business works.
Yeah.
Like there's things that unexpected like hiccups all the time. And that's okay. Like that's just the way that life, right? Like this really funny thing I always see is a company does a big acquisition like Natroba, and then like the next quarter the margins are lower because like they have all these costs of like
Yeah.
integrating the businesses and all these like acquisition costs, and people are like, oh, it's like a bad acquisition, like the margins are like terrible, and it's just like, are you for real? Like you just gotta like think about this is like a business. They don't just
Yeah.
like buy the thing and then the spreadsheet like works right away. But that's how, especially like in the microcap space, and this is why there's a lot of opportunity.
Mm-hmm.
Is like people think that way. They have no patience, and they just like they want everything up and to the right every quarter. And it's like that's just not how the world works. And so you get your buying opportunity. It can be frustrating, right? Because you can be very right about a thesis and still just like have the market not agree with you for a long time.
Mm-hmm.
But eventually, like the earnings power manifests and people can't ignore it. And then you get
Mm-hmm.
paid, right? So I don't know. It's like I'm looking at the Cipher chart right now, and it's like, if you sold this, basically it's done nothing since a year, like
Mm-hmm.
July, basically,
Yeah.
right? Nothing. So you've just been on dead money, and meanwhile the market's gone up like a fair bit since then. But it could just like overnight go to 20, and then you'd be
Mm-hmm.
like, well, it was like fine to wait a year. And like so I don't know. It's always just interesting psychology, but I think, one of the morals of the story is like uh you kind of find like the businesses that you figure out well and understand and trust. And sometimes there's like a lot of value in that, right? Like
Mm-hmm.
you just kind of wait, but you're not going to get a lot of opportunities where you get this like huge insight, and then you're just kind of like, I feel like a business owner in this company, so I don't need every single year for the like chart to go up. It doesn't really matter as long as like the intrinsic value is growing, and it is clearly growing. You
Yeah.
can like see every quarter that like, first of all, like the acquisition that they did has like kind of exceeded the bull case even. And now the company's buying back shares, and like, encourage people to like, if their shareholders are interested, like reach out to like investor relations and like ask questions, right? Because you're gonna understand, if you ask the right questions, you're probably gonna understand things better, right? Like, here, I'll give you like an example about this company, right? Like, there is like, it's all disclosed, but it's like there's a litigation that they have right now with this company, Sun Pharmaceuticals, who basically, Sun is the company that they licensed Absorica to in the US. So they're a
Mm-hmm.
partner in the US. And there's litigation between the parties, right? And they're in arbitration right now. And like, Cipher has sued Sun
Okay.
for a misuse of the data. Basically, there's like um, uh, data for the Absorica product, like through the trials, and Sun was only allowed to use in the US, and there's an allegation they used in Canada, right? And this is what the litigation's about. And then it's just like, okay, well, like, let's think about what that is, right? Nobody's thought about this, but it's like, maybe there's like a big monetary award if they win this arbitration,
Mm-hmm.
right? It's like, there's disclosure that this litigation is ongoing and the filings, but like, it's easy to just kind of like gloss over and not think about it, but like maybe there's something there. And so you can like double click on that and go explore, like, hey, this company makes like, and look, I have no idea, right? Like arbitration filings, unfortunately, like in the US, everything's like public in the court system, but like Canadian arbitration thing going on. I don't know if it's
Mm-hmm.
Canadian, but there's no like public filings as far as I can tell. You can kind of think it through and be like, okay, well, maybe like if Absorica's stealing market share that otherwise would have been Cipher's, and maybe they make money. I don't know,
Mm-hmm.
right? But maybe that's an extra if they make $10 million on it, that's 5% of the market cap. So there's always like, I think when you get really close to these businesses, you start like piecing things together that other people aren't seeing, right? Like most people are just looking at the income statement and the balance sheet and not being like, well, where are those like value drivers? Where are these like ways to win? The other one that's really interesting is Absorica, that drug that was uh, licensed out in the US, and it's declined, like it's almost gone to zero in the last couple of years,
Mm-hmm.
because like, at least according to Cipher, like Sun is not really like uh, putting enough effort into marketing the product. That
Mm-hmm.
agreement ends with Sun in 2026, so in 18 months at the end of the year. Then there's a question like, restructure the partnership, or maybe they take that product and they bring it in house and they bolt it on to the Natroba business.
Mm-hmm.
Right. Again, you get that like fixed cost structure that's already in place. And with enough incentives, maybe they take some share back and they get to capture all of the economics rather than just take like a licensing, like a royalty. Right.
Mm-hmm.
So, there's a world in which that ends up becoming like a big deal.
Yep.
um, if they can sort of, you can back into that math somewhat, right? Because right now they just earn like a royalty, so they're just probably earning like 3% or whatever it is, right? Some percentage of the sales, and then you can bring all of that in house with a cost structure that's already in place, and then like put some more effort into marketing, and like who knows, maybe it's like another 10 mil of EBITDA or something. I don't know. I don't have the numbers off the top of my head, but I'm just kind of spitballing. But you get really close to your company and you can sort of start mapping out different ways that they can win that I think
Mm-hmm.
a lot of people don't think through because they're just reading like the income statement.
Okay. Yes. Thanks, Dylan. That's a really comprehensive overview of Cipher. I think it's a lot of things that people who are willing to do their own due diligence can start over with. And it's this litigation. This is the first time I hear about it because, yeah, I have just went through the income statement. I've listened to the interviews from the
Yeah,
CEO. I was really excited about their goal to do the NASDAQ listing to increase the market share and bring more investors. So
yeah,
yeah, thanks a lot. Before we
of
go,
course.
can you
Yeah.
recommend any books that you are reading or TV series to the listeners?
So I always tell people the best, at least I think the best investing book is called Capital Returns.
Mm-hmm.
I always say this on like every podcast, so it's boring, but like this book is like I think just so valuable to read if you're like learning. I mean, even if you're like an experienced investor. And we didn't really talk much about this because like Cipher doesn't really fall into the category so much, maybe, but like these guys, I think, especially the first few chapters. So it's basically like compilation of marathon funds, like commentary on certain ideas, and they basically it's a lot about like capital cycles and about like actually they talk about a lot about quality of management. So some things that we talked about here today, but they basically lay out like a very interesting framework.
Mm-hmm.
And a lot of what I do is trying to like apply those principles to what they said. So like and talk about this, but I have like big investments in a couple of cannabis companies in
Mm-hmm.
Canada, uh, and some movie theaters. And these are kind of like businesses where like they're like capital cycles. So like they're kind of hated by the market, but something's changing. And they do a really good job with that. And I think like if you again like take seriously and literally what they're saying and try to like think that through in your own sort of like apply it to your own analysis,
Mm-hmm.
you probably do really well. So I always recommend that book to people.
Okay, thank you. So before we go, can you tell listeners where they can find more about you?
Yeah, for sure. So you can just go, it's Raging Bull Cap on Twitter.
Mm-hmm.
And then there is a link to my Substack on the Twitter, which is just Raging Bull Investments.
Mm-hmm. And the people who wanna learn more about your fund, do they have to reach out to you directly?
Yeah, you can just send me a message and we can
Mm-hmm.
like talk about it. But yeah, I don't really advertise it. So um, the place to find me is just on Twitter and then
Mm-hmm.
yeah on Substack. But I'm always my inbox is always open. So yeah, I try to respond and I usually do. So people can feel free to reach out.
Okay, sounds good. Thank you a lot,
Cool.
Dylan. It was a long
Thanks, man.
podcast, but
Appreciate it.
really comprehensive.
Yeah,
Yep.
I'm glad it was helpful.
Yep.
Cool.